Initially, the idea about becoming a real estate investor sounded pretty cool, but then I'd realize that I have to take late night calls from tenants with problems. Who has time to manage real estate when trying to run a practice, raise kids, stay married, and stay in relatively good shape? Fortunately, I learned that there was a hands off approach to real estate to avoid these 2 a.m. calls, which is exactly what we're going to focus on this video. If you're new here, I'm Dr. Jeff Anzalone, a periodontist on a mission to break you out of the rat race by teaching you how to build passive income while still working at your 9 to 5. You can get started by downloading my free passive income guide with the link that's below this video. Let's get going. Now, you may be asking yourself, what's a hands-off approach to real estate? Well, my favorite investment is a real estate syndication, which basically is a pooling of money with other passive investors, that's like you and me, other passive investors, to purchase property such as apartments, mobile home parks, or maybe even self-storage. Now, there's actually two main groups involved. The first one is what's called a general partner or a GP, and they have more of an active role in the process. They go out and they find these deals. They're looking at the numbers, they're underwriting, they're trying to figure out the best price to get, if it even makes sense to even make an offer. Then if it does, and they go through the process, they get it under contract, they arrange inspections, get financing, property management, keep it leased, all the things that's involved in running a real estate business. That's the general partner's role. Now, your role and my role as a limited partner, uh, we choose to, if we choose to invest, we're investing passively with limited additional risk. So basically, this group, they're in a passive role. They have no active responsibilities in managing the asset. Now, my other favorite real estate investment is what's called a real estate syndication fund. Now, if you're familiar with investment funds, you're probably familiar with investment funds such as money market funds, mutual funds, and private equity funds. Real estate syndication funds are actually a pool of capital that's been aggregated on behalf of multiple different investors that really is exclusively focused on income generating property. So instead of one particular real estate syndication, let's say an apartment syndication, you can have a fund with multiple different apartments or self-storage, mobile home parks, or whatever. So think of this, a syndication, as a single stock, and think of a real estate syndication fund as a mutual fund with separate single stocks in there, all in one. All right. And so again, with these as well, typically they're led by a sponsor or general partner that goes in and they get all this combined capital that's in the fund and they invest it into properties, and it's under one actively managed portfolio instead of multiple ones all spread out. Now, these funds are broken down into three different categories: closed-end funds, open-end funds, and fund-to-funds. So let's start with the closed-end fund first. So a closed-end fund basically has a manager that sets the predetermined life of the fund. And the majority of these are what's called a value add in structure. All right. The majority of the syndication deals that my wife and I are invested in also reside in this value add class as well. Now, what this means is the general partner or the sponsor, they acquire an asset. Let's say like an apartment building, and they buy one. Maybe it's a little bit older, needs a little rehab, needs a little TLC. So many times, these different types of updates need to be made both to the exterior and to the interior of the building. So if they need to update the fixtures, flooring, carpet, granite countertops, update the appliances, cabinets, painting, new lights, landscaping, parking lot needs to be resealed, those types of things. Now, these closed-ended funds, they're capital gains driven, okay? Which means that most of the expected return is earned from the sale of the asset, the sale of the property versus the income stream. Now, as you can imagine, if they're going to rehab something like this, it normally takes several months to even years to implement this entire rehab process. So therefore, the closed-end funds, they actually may deliver negative returns initially in the initial years. So it's critical, again, to perform your own due diligence on the sponsor or the general partner's track record, as these funds are actually contingent on the execution of whatever underlying business plan there is. All right, so that's open-end fund. That's closed-end fund. So the next is an open-end fund, and these types of funds, their structure, unlike the closed-end fund, the open-end fund, they actually have no termination date. So because of this, they mainly employ what's called a buy, fix, and hold strategy. Because most of the expected return is actually derived from the property's income stream. Remember, this type of fund, closed-end fund, capital gains driven, they're looking at the majority of the income coming in on the sale of the property. Open-end fund, this is more on the ongoing income stream. So the main advantage of this type of fund structure has to do with flexibility. So sponsors can actually focus on long-term capital appreciation for their investors, and they aren't forced to always be focused on liquidating assets, turning them over. But the need to produce strong recurring cash flow, if they're focused on that, it could potentially reduce the income stream, which results in a lower overall return versus the closed-end fund. Now, something else to consider is that open-end funds, they typically have a little bit lower risk profile because immediate cash flow, again, is part of the acquisition criteria. All right. And last but not least is something called a fund of funds. So a real estate fund of funds is basically a portfolio holding of real estate funds rather than investing directly. So by investing in a fund that invests in other funds, passive investors get the added protection of actually more than one fund manager plus increased diversity versus one single fund. That's a fund of fund. So let's get into the 5 main benefits if you decide on, instead of investing in a single syndication, if you decide on investing in these real estate syndication funds. The first one is diversification. So one of the questions members of our passive investor circle, they typically ask, has to do with investing in one or multiple syndications during the year. So for example, I'll get asked, hey Jeff, I've got $200,000. Should I invest $200,000 in one deal, like one apartment complex or one self-storage deal, or should I split it up and invest $100,000 in apartment A and $100,000 in apartment B? Well, investing in a fund actually solves this dilemma when it comes to being diversified within this syndication space. So most of the funds that I invest in, they offer anywhere from 4 on the low end to 10 or more different assets. So you're going to get even more diversification when you invest in a fund versus a single syndication deal. The second benefit is profitability. So funds are structured, again, like syndications, as they look to return investors profit before any profit is earned by the fund sponsor. Most funds offer this preferred return model in addition to their pro rata share of the fund's overall net profits. So in this structure, passive investors, you and me, we're assured that we're going to receive the initial profits from the fund's investment activities before the fund sponsor gets their share. And their share is what's called the carried interest. So the fund, all these deals, they have to perform. So any initial profit goes to the passive investors first, you and me. And then once they hit that threshold, that preferred return, anything left over, that's when the general partners start to get paid. So as you can imagine, the way that this is set up, it highly motivates the sponsors to ensure that the deal, or in this case, the deals, achieve the intended profit threshold. This is great for the passive investors as it keeps the interest aligned between them and the sponsor. Number three benefit are the tax advantages that you're going to get. So with the real estate syndication fund, just like a single syndication, you're going to typically invest for the long term. Now, most of these funds, they're structured to last longer than a year. So because of this, they're going to be taxed at the long-term capital gains rate instead of the short-term capital gains rate. So this actually is going to be a lower rate. And limited partners, they may also benefit from pass-through depreciation as well. Now, as with all tax matters, the benefits that accrue to the passive investors will be dependent on their accountant's advice regarding their own unique circumstances. So if you don't have an accountant, if you're wanting to get into syndications or funds or any type of real estate, it's imperative that you get an accountant that knows about real estate, not just, oh yeah, I have a couple of clients, they do a little bit of real estate. You really need one that really knows the in and outs to give you the best benefits, because that's one of the main reasons that you're probably going to want to invest in these as well. Fourth benefit, flexibility. Now, investing in a fund provides more control and flexibility versus, again, putting money in a single investment asset. So, for example, if an investor who wants to put in $400,000, well, they can choose to invest that in $100,000 tranches across four different funds. Investors can also choose the different types of property they want to invest in, like the different types of asset classes, along with their different locations throughout the US, or wherever you plan on investing. Now, this allows customization in their portfolios without having to directly buy individual assets. And last but not least, the fifth benefit is absolute returns. So a fund's absolute returns refers to the amount of profit that the fund has earned. These include any additional returns above and beyond the preferred return that we just talked about. The funds that perform exceptionally well will provide absolute returns significantly higher than the anticipated preferred return. So, as with any type of investing, as you can imagine, a fund's past or current performance does not guarantee its future performance. I recommend that you basically base your investment decisions on the experience and the track record of this guy, this group, the sponsor. Now, if you're a busy professional aspiring to reach work optional status in 7 years or less, I can't think of a better investment tool than real estate. Now, besides syndications, real estate syndication funds are just another option with a unique way to diversify your portfolio without the hassles of direct ownership. That's the part that I like the best. I don't have to deal with tenants, somebody else does. Now, as previously mentioned, the most important part of investing in syndications or funds or both is vetting the sponsor, vetting the general partner group and their track record. Now, if you want to learn a little bit more into this process, my process of how this works, check out this video over here. We'll take a deep dive. I'll see you over here.